Hi everyone, welcome to this episode of the Personal Finance Playbook. I'm your host, Jack Wang. When it comes to getting a mortgage or refinancing, there are a lot of letters: FHA, VA, USDA, Fannie Mae, and so on. My special guest today helps people navigate through that very confusing and often stressful process to get to their home of their dreams or to lower the payment on their home of their dreams. My special guest today is Lisa Corey, independent mortgage broker. She has over 20 years of experience in the mortgage industry, I think more than that, having worked with various mortgage companies in the past, but now helps clients with whichever program and company would be the best fit for that client. She's a resident of Lowell and works with clients throughout Massachusetts and New Hampshire. She's a longtime friend and a trusted resource, and I do have to say also, person who goes on a lot of crazy adventures because we know each other outside of the business world. So welcome to the show, Lisa. It's great to have you on.
Thank you, Jack, for having me.
Let's get into it. So let's start very simply because I know that this is a question that you must get all the time. So how do you pre-approve someone for a mortgage? If someone says, hey, I'm looking to buy a house or I'm looking at a house, walk us through that process and what are the things that you look for?
That's a great question, Jack, because when people call, that's their first question, and oftentimes they're scared. When they want to buy their first house, they reach out and I have a conversation. So the way that we pre-approve people is we look at three ingredients. We look at their credit, their income, and their assets. So first of all, let's go over the credit. In order for people to get a mortgage, they need a minimum of a 640 credit score. And sometimes that stops people right there. And if they have a problem there, we will work with them to help them to get that credit score a little bit higher, so in the future they can qualify for a home loan. So that's the very first step, is the credit score. The second thing that we look at is income. So we need documentable income to show that they will be able to make the mortgage payment. And it's super important to me that I get them into a mortgage payment that they can manage. I do not want to get them in over their head. It's very important to me that I set them up for homeowner success and not failure. So what they do is I have them send me a pay stub and a W-2, and then I can calculate out the numbers and I can determine exactly how much home they can afford, which is based simply on the income coming in and the debts going out. When they buy a house, we know that they still need to have money to make their existing car payment. They need to have money left over to make their student loan payments if they have any. They need to have money to make their credit card payments. So we factor that in along with the new home. So then the third ingredient that we look at for pre-approval is assets. And basically what that means is, what is the down payment going to be? And what we do is we have lots and lots of different loan programs, but the absolute smallest down payment that we have out there is 3% down. Now, 3% down, the down payment always means the percentage of the purchase price. So that number will vary depending on how much the home costs. But that 3% down is the amount of money that that person needs to come up with on their own, out of their pocket, in order to purchase a home. And then the bank will lend them all the rest of the money. So it's a really, really nice, easy way to get them into a home. And that's the three simple steps that it takes to get a pre-approval from a local mortgage lender.
Okay, so thank you for that. That's great information. And so let me just follow up a little bit about some of those items. So you mentioned that 640 is the minimum, but obviously the higher the credit score, the lower their potential rate would be, correct? I mean, all other things being equal, correct?
Correct.
Okay. And then I would imagine that also that's probably true for income, not in terms of raw dollars, right, but probably in their debt to income ratio, which is what you had talked, you didn't refer to it as that, but you look at the, sort of how much income is coming in and then what other debt payments are going out. So I would imagine that the better that looks, that's probably has an impact on rates as well, to some degree.
Yes. Yes, you're absolutely right, Jack. So those are ingredients that they are looking at. They are looking at the credit score closely. Our industry, the mortgage industry, is very heavily credit score driven. So as you stated, the higher the credit score, the better the rate, the better the loan. So the goal is to always help them to get that credit score to go a little bit higher so that they will qualify for the better rate and the better loan.
Okay. And so I would imagine then that there are times where you have prospective buyers approach you, right? And perhaps their credit score is a little bit low, and so they might have to come back after some period of time, right? To work on their credit score, get it up to where it's in range or get to a rate that would be acceptable to them, I would say. That must happen pretty frequently, I would imagine, unfortunately.
It does. Unfortunately, the credit score stops some potential home buyers dead in their tracks right at the start. And I explained to them that we can't go to step number 2 until we get the credit score set and on track first. So yes, that is an obstacle for some people, but we do have the tools to help them to get that credit score to go higher so then they can qualify for a home loan.
Okay. So with all the things that people are seeing in the news these days, right, there's inflation and interest rates and there's concerns around the economy. It can be very scary. What's your outlook in terms of the buying versus renting decision, right? Because I'm sure that that you probably run into this frequently, where people, are looking for a new place to live, so they're trying to decide should they buy or should they rent. And I know mathematically there's a formula that we can use, right, to figure that out. But what's your outlook, and how would you help clients make that sort of decision?
That's a good question, Jack, and a lot of people do ask that. So buying versus rent it's pretty simple. If you want to buy a house and you can afford to buy a house, buy a house. Because rents have gone through the roof. Rents have skyrocketed. And what's happening is it's very difficult for people to even get a rental throughout the entire country. They're outbidding each other on rental properties, which is hard to believe, but it's definitely happening. So it's definitely home ownership, because when you own a home, Jack, you're investing in yourself. You're investing in your future. And by owning that home and making your mortgage payment, you're going to earn equity. You're going to earn income from that home over a period of time. I also feel strongly that homeownership is super, super important to families. It provides families with stability. Kids have a neighborhood school to go to. They have a neighborhood to grow up in. And there's no concern about, the landlord might sell the house if you were renting, and then you would have to find somewhere else to go. So there's many, many advantages to owning your own home. And if you want to buy one, absolutely go out and buy one. Pay your own mortgage as opposed to paying the landlord's mortgage for him.
Right, exactly. And I do have to say, now I'm not in real estate, but you watch the news and you keep up with business news. I don't ever remember a time where people were bidding higher than what rent is charged, right? Because we hear stories about houses, people offering over what the listing price is and things like that. And so that's not normal, I would say, but it's common enough, so it's not necessarily an unusual thing. But I've never heard that about apartments. And that's got to be a shock for everyone, which probably leads more people to ask, hey, if I have to bid over the asking rent, I should probably look at buying. Right, but then it brings up these other issues about credit score potentially and things like that. Yeah, it's fascinating. I've never seen it before. I don't know if we'll ever see it again. So let me ask you this: in the market where the real estate market is still pretty busy, we hear stories about people having to compete with dozens of other offers, right, or many other offers. Are you finding that that's still pretty common today? And do you have any tips on, let's say through a financing perspective, of ways that buyers could maybe have their offer stand out?
That's a good question. So now, Jack, that interest rates have ticked up a little bit. There are more houses on the market, and the home buyers do have more time now to go out and pick the home that's right for them and their family. It's not as competitive as it was with the over asking and everything else that was going on in the market, because now we're trending into a more normal market. Before we were in a pandemic market, which none of us, unless you're over 100 years old, have lived through. So that's why the interest rates were so low, and that's why the housing went up so high, and then it became very, very competitive. Now things are settling back into what we call a normal housing market, which is good. And get things back on track, get the levels back on track, and it's reducing the amount of outbidding each other that's going on there right now.
Okay, so that's good to hear, because I know that sometimes I'll see in the news concerns about a potential housing crash, similar to 2008, I think, and people can have different opinions about that. But now from a financing perspective, right, as you help prepare the financing for a prospective buyer, are there certain things that buyers want to do with their working with someone like yourself on the financing side that will help them stand out? Are there some things, or is it pretty, not normal, I won't say normal, but or is it pretty cut and dry, I guess, on the financing side?
No, there are definitely things that buyers can do to stand out. One of the simplest techniques, though, is to put a large down payment down. The sellers and the sellers' realtors feel more comfortable, knowing that somebody has a larger down payment versus somebody who has a smaller down payment. It's not necessarily fair what's going on, but that does shine a brighter light on a multiple offer situation. They definitely prefer the person who does not have a home to sell in order to buy this new home. That makes them much more appealing as a potential buyer, because they can just buy it, move in quickly with no delays on the other side.
Okay, sure. Yeah, I think generally fewer contingencies, generally better, right? And that makes sense. So Lisa, what trends are you seeing out there in terms of sales, in terms of financing, or different programs being used for financing? We'll talk about rates in a little bit, but generally the structure of the deals. What are you seeing out in the marketplace today?
Now, in the mortgage industry, what's trending now that we're heading back into this normal market, now that things are slowing down a bit, we're trending a little bit more towards non-QM products, which simply means we can use somebody's bank statements to qualify them for a loan.
And so before you get into that, because I definitely want to hear about that, can you just, for our audience, just define what QM stands for?
Qualified mortgage.
Qualified mortgage, okay.
So it's a non-qualified mortgage program. And so now we're able to step outside the box a little bit. Now we're able to do loan programs that are a little bit outside of the ordinary, and now we have a little bit more flexibility with what's happening in the market. Now we don't have to do just a conventional 30-year fixed, larger down payment. Now we can do other things, and this is going to help other buyers get into the market who were unable to get into the market before.
Right, but to a certain extent, though, going back to your prior question, I suppose it's a balancing act, right? So if you have a situation where, let's say, someone doesn't have a lot of income for whatever reason, but they have a huge amount of assets and a good credit score, versus someone who has a lot of income but maybe no assets, right? All these different situations. you want to obviously help them and get them qualified. But at the same time, I suppose you want to balance that out with what a seller wants to see, right? Because not everybody's going to have that large down payment and the huge income, or the really high, or I'm sorry, the really great debt income ratio, right? So it is, you're trying to do the right thing for the prospective buyer, but you also you want that offer to be accepted too, right?
Yes, you're absolutely right. It's a very fine line, because I can get them the best loan to suit their needs, but if they are continually putting out offers, and they don't get an accepted offer, we don't get the opportunity to give them that amazing mortgage that's perfect for their needs. So yes, you're trying to please both sides, and the name of the game is to get them an accepted offer, but then at the same time to get them a loan, a good loan, that again, that they can manage, that's not over their head, that has a payment that's comfortable for them.
So just in your opinion, you're starting to see more of these non-qualifying mortgages. What do in your opinion, what's driving that? Is it really changes because of the pandemic, or are you just having more sort of unusual situations coming out of the woodwork? What's behind that?
It has to do with our mortgage industry. Because things are slowing down, they're looking at other programs to bring loans in for people that don't qualify the traditional way, and they're just trying to open up more lines of financing to help more people. Okay.
So I didn't know necessarily if that was because like the nature of work changing, or people going into self-employment as a result of the pandemic. People talk about the Great Resignation and things like that. Okay, so that makes total sense. So one of the other things, of course, that are on people's mind today is interest rates. After hitting just absolute historic lows, over the last X amount of time, they've trended up a little bit. Still pretty low historically, but they've trended up, and the Federal Reserve has announced that they've intended to raise interest rates. What's your outlook, or what have you heard in terms of the outlook for interest rates going forward?
So yes, we look very closely at that in our industry, and we look at the graphs and we look at the historical data. And based on all of the historical data, rates have gone up, as we all know, but they're going to come back down in anywhere from 6 to 18 months, because that's what they do historically. They go up and then they'll stay up for a period of time. We can't predict exactly how long, and then they will come back down. So they're not going to come back down to pandemic rates, because that was an abnormal market. Now we're back into a normal market, so they're going to stay in a normal range. And what's super interesting about this is the highest rate that we've ever had was in October of 1981, and it was 18.63%.
Wow. Right. It's interesting that you really say that, because I think about that, and I'm old enough to remember those days. So I do always kind of chuckle that when, when people talk about, oh, my rates are going up, and my interest rate's going to be high at 5%, 4%, whatever that number is.
Right.
And I think back, yes, it was a long time ago, but it really wasn't that long time ago, right? So if you're sort of saying, well, 5% is really high, or whatever that number is, it's a lot better than 18,
exactly.
Right? Because I don't want to go back to 18. So I just really laugh at how people say, oh, it went up a quarter point and now it's so high. It's like, well, it's historical perspective, right? So I'm really glad you brought that up, because sometimes I think we lose that perspective when talking about things like interest rates, like, when people are fighting over an eighth of a point or a quarter of a point. It's like, well, you can go back to 18 if you really wanted to, but nobody would want that, right?
Exactly. So anything below 18%, I think we're having a good day.
Right. Exactly. Not everybody might feel that way, but it's true. It's true, right? It's absolutely true. So let's talk a little bit about the different programs. And so I know that because there's the alphabet soup of mortgage programs. So take a moment, if you would, and tell our audience a little bit about some of the more popular ones that you tend to use or tend to see.
Sure. So I think one of the ones I want to talk about is one of my favorite programs that we have right now is to help first-time home buyers to get into the market, to get their foot in the door and become a homeowner. And in that program, we call it Borrow Smart, we are able to give them up to $2,500 towards their closing costs. Of course, they have to qualify. But still, the fact that I am able to help, number one, a first-time home buyer, which is super fun, and then number two, to be able to contribute $2,500 towards them buying their first home is a super exciting, and it's a super fun program. And obviously, I love doing that one.
Right. Yeah, and obviously your client base is not just first-time home buyers,
No.
but that's where you can really help them, and like you said, also with the down payment and things like that. And so that's really good. That sounds awesome. But are there, as you help first-time home buyers, besides the qualifying mortgages, are you seeing them in certain go to certain mortgage programs more than others? Like we mentioned, like VAs and I know there's a USDA one, and then of course there's FHA, and and all that stuff. Do you find that one tends to gravitate more towards one of those programs more than another?
So that's a good question, Jack. So that's really on me to figure that out for them. Now I have the facts, I have their credit, I have their income, I know how much the down payment is, and now I need to figure out what's the best program to fit their needs. And when the market was very competitive, it was all conventional 30-year fixed, conventional 30-year fixed, because their offer wouldn't have gotten accepted, anything other than that. Now that we're, back to shifted into our normalized market, now if somebody needs an FHA loan because that's a better fit for them, that's basically for a lower credit score borrower. Lower credit score, smaller down payment. Then that's the better loan program for them. And yes, there are VA loans out there, which are a wonderful, wonderful loan for a veteran. I describe it as it's the government's way of thanking the veteran for their service. The government, they really give them a really, really good home loan to get the veteran into a home.
Okay, sure. Let's switch gears for a moment, and we've been talking about purchases.
Yes.
Let's talk a little bit about refinance just for a quick moment. Is there a rule of thumb? Maybe there is, maybe there isn't. But if so, is there a rule of thumb at which point people might want to look at refinancing their existing mortgage? Like there's a certain rate differential or a certain scenario that tends to make sense when they say, "Hey, Lisa, we should probably look at refinancing." Is there a rule of thumb like that? And if so, what might that be?
Yes, so people are going to continue to refinance because life happens. So now what happens is it's not really about lowering the rate. If we refinance them over the last couple of years, we cannot lower the rate for them. However, what happens is people need money to pay for college. People need money for home repairs. People need to refinance to pay off debt. There's divorces, unfortunately, happening. So people's life situation happens, and oftentimes we'll look at doing a refinance so that they can access that equity that they have earned in their home. They own that home, they've made the payments, they've been doing all the maintenance on that home, they've earned that money. So we will often refinance to tap into some of that money so that they can use the money for whatever their needs happen to be at that time. So what's interesting about loans is that the average loan not the house, the loan is 6 years. So people keep their loan for 6 years. They may keep the house for 30, but they don't keep the loan.
Right.
So back to your point about people getting all stressed out about the rate and the quarter of a point, it matters, but it doesn't. In the big picture, there's the potential that they will probably refinance within the next 6 years.
Right. Okay. Yeah, I've seen something similar to that before as well. No, thank you for that. So, I know that realtors and yourself get the question, should I rent or buy? But you also have a different question sometimes. And so this will be our last question. We just have time for this last one. But I know that mortgages really do come in two flavors in terms of the rate. There are fixed rates, like you said, but there are also variable rates of different types, right? Does it ever make sense to get a variable rate? And if so, what type of scenario would make sense for a borrower to take a variable rate?
That's a good question. People are scared of the variable rates, but we do offer them because a large part of our job is to give them options, and say, based on your scenario, here's some viable options for you. And we will look at an adjustable rate, also called an ARM. And all it means is that the interest rate is fixed for a specific amount of time. Could be 5 years, we have a 7-year fixed, we have a 10-year fixed. But it's spread out over 30 years. And I don't want to confuse anybody with that. But it simply means that if you pick a 7-year adjustable, that the rate will change in 7 years, depending on what the current market is doing 7 years from now. And based on what's happening, we have no way of knowing what's going to be happening down the road. So yes, an adjustable rate is a good idea for somebody if they don't plan on staying in the home that long, because the advantages of it are you get a lower rate, you get a lower payment because it's an adjustable rate. The other advantages is if they know they're not going to keep that loan for more than 7 years. And then they could keep it for 7 years, in our example, flip out of that into something else down the road.
Okay, right. And like you said, the average loan only lasts 6 years, even though the house might be a lot, right? They might stay in the house a lot longer.
Right.
Thank you so much. And thank you all for watching this week's Personal Finance Playbook. I hope you enjoyed the information, and many thanks to my special guest, Lisa Corey, who's an independent mortgage broker. Because again, I hope you've learned something. I've learned a lot. So thank you again for watching, and stay tuned next time when we have you on the Personal Finance Playbook.